I always tell everybody, as soon as you think your loved one needs care, you make that phone call immediately, because the worst they can say is, you're not time yet. That's the worst thing they can say. And then you make the call the next time you think, okay, it's time now. Get that clock started ASAP. It's pretty easy to get these things activated and going, and then you start collecting checks, and they will work with you to find caregivers. They will work with you to find facilities. You don't have to take their advice, but they're there to help you.
My name is Jamin Garabedian. I am the founder of Assurance Wealth Management. Today I have Jean Osman with me, who is our long-term care specialist and partner that helps us with the long-term care side of things, because there's a lot to it. So, Jean, thank you for coming here today and helping us out answer a bunch of these questions.
My pleasure.
As typical, again, for anybody who has joined us in the past, basically, this is just kind of an interview style where I'm going to kind of rapid fire a whole bunch of questions at Jean and let her use her expertise to fill us all in on a lot of the questions that we get asked on the topic of long-term care. We are not tax professionals. We are not estate planning lawyers. None of this is information that you need to go run off with and do something with immediately. This is all for educational purposes. If you do have any questions, if you have something specific to your life or your situation, please contact us and ask us questions and make sure that you get things taken care of that meet your specific needs, and not just run off with this information thinking that we're talking to you to go and make changes to your entire financial life today. So it looks like everything's working properly. We will go ahead and get started with long-term care and how the landscape is changing constantly. We'll start with the most basic question, Jean. What does long-care insurance or long-term care actually cover, and what doesn't it cover?
Sure. Long-term care insurance, really, when you think about it, it's at its most basic form, it's what you do when you get up first thing in the morning. You get up, you get out of bed, you go to the bathroom, you take a shower in the morning, you go to the kitchen, you get something to eat, you get dressed. It's that first 15 minutes after you get up in the morning. It's eating on your own, bathing on your own, dressing on your own, using the bathroom on your own, getting from a bed to a chair on your own, controlling your bladder and your bowels on your own. It's all of those basic activities of daily living. And can you do those things independently, or do you need help with those things? It's the things that are not specifically medical, but it's getting by day to day and being able to take care of yourself. Those are the things that long-term care covers, and all the help with those things that Medicare does not cover.
Okay. And so when you're talking about those activities of daily living, are all insurance carriers a little different as far as how many of those that you need to be able to do on your own or need help with before you're actually covered? Or how does that work?
No, there's a standard. The tax qualification for long-term care, in order for long-term care benefits to be tax-free, in order to meet the standard of long-term care, the definition needs to be the same across the board. So you need to have lost at least 2 out of those 6 standard activities of daily living, or have a severe cognitive impairment that's requiring supervision. So it's either losing 2 out of the 6 or more, or having a severe cognitive impairment that qualifies you for needing a long-term care policy or having those benefits kick into action. And it's across the board. Any long-term care plan is going to have the same standard. It's by definition 2 out of 6.
Gotcha. And what have you seen be kind of the most common triggers for the benefits to actually kick in?
Yeah, usually we see the first 2 to go, or I've witnessed the first 2 to go, being bathing and dressing. Simply needing standby assistance to help someone get you in and out of the bathtub, someone there to hold your elbow, or get you, so you don't slip and fall, getting you in and out of a bathtub or in and out of the shower. And then, I joke around and say that, which is true, when I was a lot younger, I was a gymnast, and, I've worn out parts of my body to where on certain days it's a little tougher to bend down and put on socks. And I'm sure when I'm 80 years old, it's going to be even harder to bend down and put on socks, or lift my arms above my head and put a sweater on. So, those things get a little trickier when you get older. And it doesn't take that much to lose the ability to put your arms over your head and manage to put a sweater on and wrangle it yourself. And by the time you get to be 80, 85 years old, doing that independently, or doing the little buttons or the snaps on your clothing due to arthritis or Parkinson's, or, whatever your individual condition is that prevents you from being able to manage those little buttonholes, that's not that far down the road.
Gotcha. And who is it that makes the determination that you can't?
It's typically your doctor. Your doctor is filling out the paperwork indicating that, you do indeed need help with these couple of things. And the carrier, the insurance company, is looking at your doctor's notes and reading your doctor's notes. But it's your doctor who's really saying, this is what I'm seeing. And they need help with these 2 out of the 6 activities of daily living. And those being the eating, bathing, dressing, toileting, continence, transferring, getting from bed to chair.
And so is long-term care insurance, it's insurance, so I'm assuming it's much like life insurance, where the older you get and you start the policy, the more expensive it gets. So is there a right time to get long-term care insurance? Is it better to get it when you're younger, or how does that play a factor into when you decide to get long-term care?
Yeah, the tough thing about long-term care insurance is that if it doesn't matter how much money you have, if you don't have the health to be able to buy the long-term care insurance, it doesn't matter how much money you have. So the earlier on that you can buy it, not to mention the fact that a lot of these policies come with inflation, or they come with compounding factors on them, so that you can buy a benefit today and put on a feature to it that's compounding that benefit over time, so that whatever benefit you buy today is going to compound over the years and get bigger and bigger and bigger. So the younger you are when you buy that and you put that compounding feature on it, in those last few years, that compounding feature, I think it was Einstein who said the most powerful in the universe is compounding inflation. So those last few years of compounding inflation are what's really going to have an impact on your benefits. So the younger you are when you can get that in place, not only can you take advantage of maybe a preferred health discount, but you can put that compounding factor on there to where those last few years, your benefits could be growing exponentially from year to year. Gotcha.
And you mentioned that it covers things that maybe Medicare doesn't. What specifically would you say that like the Medicare does not cover that maybe a long-term care policy would?
Well, if you look at your Medicare statement, it specifically says Medicare does not cover custodial care.
Gotcha.
Medicare is for doctors and hospitals, specifically doctors and hospitals. It's really kind of interesting. Medicare will cover very specifically for the first few days, the first 100 days in some cases, care in a rehabilitation center under very specific circumstances. But no matter what happens, at 100 days, Medicare cuts off and you're on your own. Okay. And so that's the most Medicare is going to help you with this type of care, at the very most 100 days and under very specific circumstances. Medicare is for doctors and hospitals, not to help you get through the day.
Gotcha. And is there anything pertaining to long-term care that a long-term care policy would not cover?
It's not going to cover medical care. It's not going to cover things like if you need chemotherapy. It's not designed to cover that. That's what Medicare is there for. So
they're working together, basically. The Medicare helping with the actual
Mm-hmm.
prescriptions and hospital visits and doctors and all that. And the long-term care is more of the help doing your day-to-day activities.
Exactly right. Getting through your day.
And so, I've always heard that there's lots of different ways of getting long-term care. I mean, you can get partial coverage or full coverage. You can get the riders in different policies versus just getting a standard long-term care policy. I mean, how do people know what kind of coverage they need?
I think that long-term care insurance has become, in many cases, very expensive. And so I think what's the most, just the smartest way to go about it now is to look at your overall financial picture and know that when you're 85 years old and you're probably going to need this type of care, you're still in all likelihood going to have other sources of income coming in at that time. You're going to have maybe a pension or Social Security or maybe annuity income coming in at that point. You're going to have other sources of income coming in that you can count on that when you're 85 years old, you're probably not going to need to jet off to Vegas every weekend to provide yourself with the best care possible, right? You're going to want the best care possible at that point in your life. So put it towards the best care possible. But the way the cost of care is going up, it's probably not going to be enough. So look at a good cost of care calculator online, a good cost of long-term care calculator, and estimate how much care is going to cost at that point in your life and fill in for the gap. So say if you're going to have $7,000 worth of income coming in at that point in your life, but your cost of care calculator is telling you that the average cost of home care at that point is going to be around $12,000 a month, then you really only need to fill in $5,000 a month in long-term care coverage. Just fill in for the gap of where you're going to fall short so you never have to rely on Medicaid. That's the worst case scenario, is relying on Medicaid. Buy a long-term care solution that's going to fill in for where you fall short.
And do you know, just off the top of your head, this is kind of a random, we didn't talk about this, but what an average cost is these days? Like a national average or anything?
Yeah, I mean, the national average can vary wildly across the country. Believe it or not, Alaska is one of the most expensive places to get care just because of the supply-demand, kind of imbalance. But typically, if you look for what nursing home coverage is, the average home care stay is roughly half of that. So an average nursing home, halfway decent nursing home these days across the country on average is maybe right now around $9,000 for a private nursing home room on average across the country. So the average home care stay is maybe $5,000 a month. It's going up though. So it's not how much is it today, it's how much is it going to be when I need that kind of care down the road.
Yeah, and because the reason I asked is because we're in Texas, and I actually had somebody come in yesterday who was having this exact same discussion about long-term care, and she was mentioning that she's looked around and she found here in Texas that because her husband's going to need, they're looking for a facility for him because he also needs the mental care, and I think she found that for him, for places that he would not need 24-hour assistance, which obviously he does, but places that don't need 24-hour assistance were $4,000 to $5,000 a month. But for care like what he's looking for, she said she saw everything from $6,000 to $15,000 a month, and so it can get very expensive.
It can get very expensive, and if you want really good care, then you need to budget for that, and you need to plan for that. And I will tell you, it's a heck of a lot easier to spend an insurance company's money than it is your own. I mean, when you're writing that check out of your own checking account each and every month, it's a big difference than when you're just spending an insurance company's money each month. It's a heck of a lot easier to spend an insurance company's money than your own, I will tell you. You just get better care.
I think it's always easy to spend somebody else's money.
You just get better care when you're spending an insurance company's money because you're spending it that much more freely.
Yeah. And you mentioned like the traditional policies and how they're getting so expensive. And then, they've also got the hybrid options and then the linked benefit. I mean, so what is the difference between all these different types of options out there?
Sure. The traditional long-term care policies had really two big problems with them. Traditional long-term care policies, the two big problems were that they were use it or lose it policies typically, and the premiums were not guaranteed. And there are a lot of people out there right now who are rolling their eyes as I say that because they're experiencing rate increases as we speak. So those are the two big problems with traditional long-term care. There were other minor problems, but those are the two big problems. Use it or lose it, and the premiums were not guaranteed. So you're getting rate increases down the road. The new hybrid policies or asset-based policies is a better way to put it.
Okay.
Those policies have either a life insurance core to them or an annuity core to them. So they have an asset at the center of them, which means they're not use it or lose it. If you don't need long-term care, then a tax-free death benefit passes on to your heirs, or an annuity value passes on to your heirs. So it's not use it or lose it. And if you buy a life insurance version of it, then you're guaranteed that even if you choose a pay to 95 version of the product where you're paying every year until you use the policy and then the premium stops, the premiums are guaranteed on those policies. So that's the nice thing about it is that you can budget for it when you first sign up for the policy because you know that premium's never going up. They're never coming back to you for more money than what you signed up for, and they're never going to lower the benefits on you. They're never going to come back and say, okay, well, you can still stay the same premium, but we're going to give you less benefits than what we originally told we were going to give you. It doesn't work that way. What you see is what you get. You're locked in.
So are benefits different from policy to policy? Like if you get, like I have a life insurance policy with a long-term care, or I could have got a long-term care rider on it. I mean, is that going to be the same as, say, the annuity product with the long-term care rider?
There are two different types of there's life with a long-term care rider.
Okay.
And then there's the asset-based life with long-term care. So totally different types of products.
Gotcha.
Life with a long-term care rider means the life insurance is equal to what you have to use for long-term care. So, for example, you buy $1 million death benefit, and now you have $1 million to use for long-term care if you want to. So the death benefit and the long-term care benefit are exactly equal.
Gotcha.
Right?
Okay.
There's a whole different set of products out there where you buy $100,000 life insurance benefit and you pay maybe $75,000 for it. So your life insurance is not the reason you bought that. You paid $75,000 for $100,000 life insurance, but your long-term care value is maybe $800,000. So you're getting a boatload of long-term care benefit, but you're getting a very small death benefit. And it's essentially just kind of a glorified return of premium. But again, you paid, relatively speaking, a small amount of money for that $800,000 worth of long-term care benefit. It's a question of where your priorities are. If your priority is life insurance, you're going to go with that one where the life insurance equals the long-term care benefit. And if your priority is long-term care, you're going to go for that big bucket of long-term care dollars and just kind of a glorified return of premium on the life insurance.
Gotcha. So how does the annuity product work? Because is it the same? Are there two different products there as well? Because I know annuities have long-term care riders that you start the lifetime benefit and you get a multiple if you need long-term care. Is there another kind of a long-term care annuity option?
There are a couple different long-term care annuities. The one that's most popular is where right now, what's really fantastic about the long-term care, the long-term care annuity options that take advantage of something called the Pension Protection Act that I love. And the government's getting into trying to convince people to buy long-term care insurance. If someone out there right now, 10 years ago, put $50,000 into an annuity, and they've been sitting on it for the last 10 years. And now that $50,000 has grown to $100,000. That annuity is now valued at $100,000. So you've got $50,000 worth of gain in it. And if you decided you were going to take money out of that annuity today, if you know much about annuities, you know that you'd be paying taxes on the gain first, right?
Mm-hmm.
The gain are the dollars that come out of that annuity first, and that's what you're paying taxes on right away. Well, the government said, okay, we know how to motivate people. We're going to tell you that if you take that entire $100,000, the $50,000 you put in originally and the $50,000 of gain, so the entire $100,000, and you move it into a long-term care qualified annuity, we've got products out there that'll turn your $100,000 into a pool of $400,000 to be used for long-term care. And if it does come out for long-term care, it's coming out completely tax-free.
Oh, wow. Okay.
So the money coming out is going to come out over a set number of months.
Mm-hmm.
It's going to be divided by X number of months. So your monthly benefit will come out however much it is each month for X number of months. And if it comes out for long-term care, it comes out completely tax-free. And if you never need it for long-term care, then your original $100,000, the $50,000 that you originally put in and the $50,000 in gain, plus an interest rate that's been growing since you put it into this long-term care annuity of around 5.5% right now, will pass on to heirs if you don't need it for long-term care. So an annuity of $100,000 that's been growing at 5.5% will pass on to heirs if you don't need it for long-term care.
Nice.
Nothing else there. And there's a whole lot to be gained in terms of tax-free leveraging.
Okay, so there's a lot of tax-free going on there.
A lot of tax-free. The government wants you to buy long-term care insurance, and they're going to do everything in their power to make sure you buy it.
And why is that? Why do you think the government is pushing so hard for you to get private long-term care versus, government assisted long-term care?
Well, if you've been watching the news and you've been watching what's happening to Medicaid, they're cutting Medicaid, slashing Medicaid left and right. And they're slashing Medicaid and they're making it that much harder to qualify for Medicaid, specifically because too many people are qualifying for Medicaid. And if you look at a pie chart of what long-term care dollars, where the long-term care dollars right now coming from in the United States, too many of them are coming from Medicaid. Medicaid is supporting too many people who are receiving long-term care, and the government just can't afford it anymore. I mean, they can't afford to be supporting as many people in nursing homes today as they are. And unfortunately, people get into a situation where they just say, well, I'll just rely on Medicaid to pay my bill for me. Well, they've lived a particular standard of living for their entire lives, and they don't realize Medicaid doesn't pay for private nursing home rooms. They pay for 3 and 4 people to share a nursing home room.
Yeah.
And they don't pay for the best nursing home. And
they pay for a nursing home.
A nursing home. And they give you $30 a month for a haircut and a candy bar. And that's about it.
Fantastic.
And that's how you spend your last days. And that's not how I want anyone to spend their last days.
No. And so if the government's pushing so hard for this, giving these tax incentives, once you use this long-term care policy for long-term care, it's all tax-free. Is there anything on the front end, or can you deduct premiums from your taxes or anything like that?
Absolutely. I mean, the best situation right now, as an individual, these policies are tax deductible as an individual. Mm-hmm. If you're a small business owner, even a sole proprietor, you have independent income. I mean, you're an independent rep, anything like that. And again, not a CPA, but the premium on these can be deducted as an above the line tax deduction, which means it goes directly against your adjusted gross income.
And is that for the life insurance, the annuity, and the traditional?
Not life insurance, just the long-term care portion. And all of these, either the traditional long-term care policy portion, or on almost all of the asset-based policies, they separate which portion of the premium is going towards the life insurance.
Gotcha.
And which portion is going towards the long-term care. And the portion of the premium that's going towards the long-term care is deductible.
Gotcha. So how does that work with the asset base for the annuity side, where you're buying the actual long-term care annuity?
Mm-hmm. Yeah,
How much of that premium, or how do they decide which part of that premium is
it's deductible. Depending on which product you buy,
Okay.
you can buy a continuation rider with those products, and the continuation rider, you can pay for the continuation rider on that one on an annual basis, and that premium can be deductible.
Gotcha. Okay. And so, you talked a little bit about the long-term care, the costs have gone up. I mean, when somebody's into one of these policies, which one of the policies, or do any of them, you said the premiums are going up year to year.
Yes.
So is that on all I keep saying three types: the annuity, the life insurance, and the traditional? Are all three premiums?
No, the traditional policies, the premiums are going up. All the other policies, the premiums are pretty much guaranteed to stay fixed. They can't go up. They're guaranteed. But on the traditional long-term care, people who bought their policies maybe through Genworth or John Hancock or Transamerica, those people are seeing rate increases. And, realistically, their policies are still platinum policies. I mean, it's unfortunate because people bought policies at a particular price that they budgeted for, and now they're seeing premium rate increases. And if you were to look, I did a comparison for a couple not too long ago where they were getting a premium rate increase, and their rate was going from $3,000 a year to $6,000 a year. But I couldn't replace their policy in today's marketplace. I couldn't give them what they already had. Mm-hmm. The benefits just were no longer available in today's marketplace. But the closest I could get, if they were to rebuy it in today's marketplace, instead of paying $6,000 a year, which is what their price was going up to rebuy, the closest I could get was going to cost them $12,000 in today's marketplace.
Oh, wow.
So they were still getting a hell of a deal.
Yeah.
A heck of a deal in today's marketplace. So it's unfortunate because people budgeted for a certain dollar amount,
sure,
but they need to realize their policies are still incredibly valuable.
Now, as far as the coverages that the long-term care is paying for, it obviously, pays for you to go into a home. But if you are staying in your own personal residence and maybe have a family member that's taking
Mm-hmm.
care of you, do these policies, will they pay your family member as your caregiver?
Some of them will. Some of the older ones are set up to pay informal caregivers. Mm-hmm. And so they will pay a family member to be your caregiver. Some of the newer policies pay out in what's called a cash indemnity style. And that gives you total freedom. You can pay whoever you want to be your caregiver if you have a cash indemnity policy. There are no limitations on how you spend that cash.
Okay. And I mean, that could be definitely helpful. Do the new policies do that as well, as far as paying?
The cash indemnity policies do. Okay. Yes.
And then for a lot of these policies, if they're not used, you said for the asset-based, the life insurance one is they get their kind of return of premium plus a little bit. Mm-hmm. The annuity gets passed on to whoever their beneficiaries are if they don't use it.
Correct.
And then the traditional policies, you said that's just basically, if you don't use it, too bad.
If you don't use it, it's a use it or lose it in most cases. Occasionally, they're built with a return of premium.
Okay.
In those cases, it's very fortunate. But those policies are very expensive.
And what type of health conditions, again, going to the three different types of choices you have here for long-term care, what type of health conditions would disqualify you from getting any of those, or are they different on each one?
They're very different on each one, actually. On traditional long-term care insurance, they are underwriting, or they're trying to weed out people who have they have comorbid conditions that are really more not mortality based or life based, but they're more things that would slow you down. things like diabetes, where you have neuropathy in your feet or tingling in your feet that could cause you to have problems walking or being mobile. If you have arthritis, that might be a trigger. Whereas someone, it's interesting with long-term care insurance, you can get coverage on traditional long-term care insurance maybe 6 months after you've had a heart attack. Because if you're going to fall over and die, long-term care insurance they're all for that.
Say they're okay with that.
That's good. If you're going to pass away quickly, long-term care insurance is good with that. Yeah. Versus, if you're buying life insurance and you've had a heart attack 6 months ago, they're a little bit more, hold back on that, and they may not issue that as quickly. Sure. Right? So it's really mortality versus morbidity. Morbidity is what they're concerned about, or things slowing you down on the long-term care side, and mortality on the life side is what they're concerned with. So anything that has life insurance in it, they're concerned with both.
And so the annuity, I'm assuming it's like a traditional annuity that your health really doesn't matter. They'll take your money either way.
There are, because there's some risk there. Again, with some of these annuities, they could quadruple what you're putting in. So there is some health underwriting there, but typically the underwriting, the extent of it is a prescription drug check to kind of cross-reference your answers from a phone interview. And in the phone interview, they're asking you things like, do you have Parkinson's disease? Do you collect Social Security disability income? I mean, these are things that put you on the edge of collecting money for long-term care. Gotcha. As long as you can say no to those, you're okay.
Okay. So it's kind of like sounds like the long-term care with the life insurance, that asset-based product is probably the most stringent. And then traditional policies maybe a little less stringent. And then the annuity is probably the least.
Yeah, it's right around in that. You're correct. That's about the, it's just a question of really, and each different specific product kind of has their own personality. Mm-hmm. So they have their own little underwriting sweet spot. So you want to work with someone who really knows the marketplace very well and then knows your health very well, so that they can get you into a product that you're going to qualify for. The one thing you don't want to have happen in today's marketplace is to get a decline on your record, because you could get a decline which could preclude you from getting another product. Gotcha. So you really want to make sure that whatever product you decide is the right one for you, that you're going to be able to qualify for it.
You led me kind of perfectly into the next one, which was, how do people choose what product to go with, and how do they choose what insurance company to look at, or financial strength ratings of these companies, or any of that? Like, how do they find red flags, or is there somebody that they can work with or figure out all of this information that obviously it's not very widely known, all these different long-term care options and what you can and can't do. So how do people find that information?
Yeah, you can work with someone like you, who know long-term care specialists who've been doing, I've been doing this for about 20 years now. You kind of, you work with a long-term care specialist who's kind of grown up in the industry, and you kind of know the personality of companies, and you know, again, the sweet spots, not just of the underwriting personality, but the financial personality. Some of these companies have chosen to really get into the long-term care field and put their emphasis in the long-term care field and put their eggs in the long-term care basket. There are a couple of carriers out there who've been doing long-term care or asset-based long-term care, or have really dove into that marketplace for almost 40 years now, where they've really sunk in and they know the marketplace very well. They know how to price their products and be around for a long time.
And so somebody like you, for example, could help somebody make sure that they're either not over-insuring or under-insuring, and they may not need a full-blown, hey, if this retirement home is going to cost $10,000 a month, I don't necessarily need to get coverage for $10,000 a month. You can work with them in figuring out where all this other sources of income and expenses and whatnot. And hey, maybe we only need an extra $4,000 a month. So let's get a policy that'll cover that. Correct?
Exactly. You're filling in for that gap. And it just depends on your particular situation. I worked with, I kind of cut my teeth in Chicago, and I worked with a woman there very early on in my career who really changed how I look at long-term care. Again, very early on in my career, I was selling directly to the public and did that for 4 years. And I was selling a very small Mutual of Omaha policy to an older lady. And I really went back and forth on, she didn't have a ton of assets or a ton of income, and I wasn't sure if this was the right thing to do and if she really needed this policy. And she saw me struggling with it, and she eventually said, Jean, just stop. I know what I'm doing. And she said, when the time comes for me to need care, my daughter-in-law is going to be my primary caregiver. We've already talked about it as a family. We've already decided that. But if I can buy this policy and it pays for an additional 10 or 15 hours of someone to come in that we can pay to take care of me, what will those 10 or 15 hours of freedom each week mean to my daughter-in-law when that time comes?
Yeah.
And so it just depends on the situation.
And that's one of the things I'm sure you've seen a million times, and we see it. And the client that we spoke with yesterday, it's a really sad story. It's her husband's kind of losing his mental faculties, or pretty much already has. And so she'll come home some days and he's just sitting on the couch pantless, and had his, pull up that he went, couldn't control himself, and just took it off somewhere, and may or may not have wiped himself and cleaned himself, but he's sitting there, basically naked on the couch. And she's so worn down by this. You always think that, your spouse or your kids will take care of you, and maybe they want to, maybe they want to, and they tell you that they will, but it's one of those things, mentally they may want to still do it. They may still want to help. They may still want to continue with this, but physically it's draining on whoever's taking care of you. These people get worn down physically.
It's too much. And if you look at each other and say, can I lift you? Can I take you from a bed to a chair? Do you want me to bathe you one day? Do you want me to be changing your diaper one day? Is that how we want to finish up this journey together?
Yeah.
And typically the answer is no. You don't want to finish up your journey together that way.
Yeah, I mean, I've got personal experience with that. My grandmother was in a home and needed help, and before we ended up getting her 24-hour care, I was the one that would get phone calls at 2 and 3 o'clock in the morning that she fell out of bed. Yeah. And let me tell you, lifting up 215 pounds of absolute dead weight is very difficult to do.
And it's exhausting.
Yeah, to get her off the floor and back into bed, or to get her to the bathroom, it's exhausting. And so, I've always been a big proponent of long-term care. Just, if you don't have enough assets or don't want to self-fund this whole thing, you need to be able to have some sort of policy in place to get somebody help to take care of them, because people can only do it for so long. You can only...
it's amazing. People look at it and they look at an illustration and they see the number $4,000 a month, and they look at it and they say, well, that's not going to be enough. Well, I will tell you, you've got a check for $4,000 coming in each month. That is a huge windfall at the time. I don't care how wealthy you are. You've got $3,000, $4,000, $5,000 coming in each month. That will be a windfall, no matter who you are or what is happening. It will be a windfall.
Well, and like I was talking about the physical side of things, that $4,000, mentally is relieving. It's mentally relieving. So, well, cool. Thank you. I mean, I think we went through quite a bit. I know we're kind of coming up on the end of time. We've got about 15 minutes left, which is usually what we leave for Q&A for anybody that has any further questions. But I think we went through quite a bit today. We got a lot of good information. For anybody that's currently here, at the top of the chat, you'll see a pinned message for a link to my calendar. If you have more questions or you want to get in touch with Jean, please click on that, schedule a call. We'll have a brief conversation to see what your questions are, and then I can set you up a meeting to talk with Gene, and we can get all your long-term care stuff taken care of for you. For anybody watching the recording of this, there'll be a link somewhere below or above or to the right, left, I don't know, wherever it ends up being. There'll be a link somewhere around here that you can click on to do the same thing and to get more of your questions answered. Look, no questions are dumb questions. Just like we've done this over Medicare, we've done this over taxes, we've done this over life insurance, we've now done it over long-term care. There's not enough information out to the general public, and Googling things is a scary thing to do because you never know what accurate information or incorrect information is out there. So please, when it comes to anything in your financial life, please don't leave it up to Googling. Call somebody and ask. It doesn't cost you anything to have a conversation. So please feel free to ask all the questions you guys need. But let's go. Does anybody have any questions that is here live that we didn't answer and that's not specific to your particular situation? Because may or may not be able to answer those. Wait a couple minutes to see if anybody's got any questions. But Gene, what got you into this? I
had a grandmother about 22 years ago. I had a grandmother go through a long-term care event, and in about a year and a half, lose everything she had saved in a lifetime to a nursing home, and just broke her heart.
Yeah.
And I thought, you know what? If I can save one family from going through what my family went through, watching her just, like I said, die of a broken heart, it would be time well spent.
Yeah. And I know that, again, talking from personal experience with my grandmother, and she was one of those people that had a good amount of money. I think when she first went into the home, she had roughly $2.5 million. Oh
my gosh.
And, between the home itself and then her medications, and then she ended up having to have 24-hour care. So she had 3 revolving nurses basically on shifts. I think she was spending through something like $200 and some odd $1,000 a year. And
what's amazing about that is that I can only imagine, with people when they plan for a lifetime to be in a certain tax bracket at the end of their lives. And when you have to raise that kind of money, that kind of income at that point in your life, it not only does it raise your tax bracket, but it raises your Medicare costs because you're in a different tax bracket now. It changes the whole financial picture of what you thought your life was going to look like.
Yeah. And for her, it was one of those, like, she had the money that she had and she didn't have any real illnesses. It was just,
it's just
she got worn down.
Just age.
Yeah. And so she, I think they say, if I remember this correctly, that the average, it's like 4.5 years once somebody needs long-term care is about as long as they live.
Yep.
She was well past that. She lived well past 4.5 years. Yep. And so it's, $200,000 a year for 8-9 years.
Oh my gosh.
You lose almost everything.
You go through it.
We do have one question here. How do you use or activate these policies once you have them?
You mean how do you activate them?
I would assume that's what he means by that.
Yep. And that's a good question. I typically, when I work with someone to buy one of these policies, I always insist that upon delivery, that the children of whoever is buying one of these policies be there at the delivery. Because I want them to know how to activate these policies. And there's a phone number. Typically, all of these policies come with something called care coordination. So there's a phone number that you're going to call, and it connects you with the insurance company, with someone who is a care coordinator, who is going to send you the paperwork to get the policy going, right? And then you're going to send the paperwork to your doctor, and the doctor fills out whatever is necessary to get the policy going, and that goes back into the insurance carrier, and they review it, and then they start sending you, most of the policies now, they start sending you checks each month to get the policy going. So it's a pretty simple process, but all of them come with something called care coordination, which is someone to hold your hand to get the policy going, to get paperwork in order, to get you through what they call the elimination period, which is kind of like the deductible period before the policy kicks into gear. Most of these policies have like a 90-day elimination period, which I always tell everybody, as soon as you think your loved one needs care, you make that phone call immediately, because the worst they can say is you're not time yet. That's the worst thing they can say. And then you make the call the next time you think, okay, it's time now. Get that clock started ASAP. And it's pretty easy to get these things activated and going. And then you start collecting checks, and they will work with you to find caregivers. They will work with you to find facilities. You don't have to take their advice, but they're there to help you.
So I have a question I actually just thought of, is that the lady that I was talking about yesterday, her husband has an annuity. It's in his name. It's his annuity intended for income. But now he obviously does need care, and she's been taking care of him this whole time. But now she's like, we need to find somewhere and get some professional help. Even though, so he's already at the stage that he needs it. Can he still transfer his old annuity into one of these long-term care annuities?
If he already needs care, the only thing that he could do at this point, since he needs care, there is one annuity out there. What state is he located in? Texas? Okay, there is one annuity out there that he could actually transfer the money into. But the only problem would be is that typically there's like a 48-month wait on that. That's how they keep people from doing it when they need care. But if you were to get to someone slightly before they needed care, you actually could move the money into in 1035 or transfer the money into one of these policies, and it would, double or triple what they put in for long-term care. Yep.
Okay. So for him, it may be too
late.
It
may be a little too late.
It's like most insurance that you need to get it before you need it.
You need to get it before you need it. Yep. Yeah. But in some cases, it doesn't need to be that much before you need to get it, but you need to kind of see over the horizon a little bit.
I think this was a lot of good information. Thank you very much for this. And
drinking from a fire hose a little bit. Sorry.
Yeah. And that's how these things typically go is, we spit a whole bunch of information at people for about 30 or 40 minutes, and then everybody's just kind of, whoa, that was a lot. So, all right. Well, we will end it here. Again, Jean, thank you for coming on. Everybody, thank you for attending. For those of you that watch the recording, again, please feel free to give us a call, shoot us an email, click the link somewhere around the video. We'll be happy to answer any of the questions that you have, or if you think that you need a policy, we'll be happy to talk you through which one may be best for you, as well as how much coverage you may or may not need. So thank you again, everybody, for coming. Thank you again, Jean, and we will talk to you guys soon.
Take care.
Take care. Bye-bye.
Bye-bye.